Hello, and welcome to episode 132 of the REconomy Podcast, where we discuss economic issues that impact real estate, housing, and affordability. If you find this type of real estate economic discussion valuable, please be sure to hit the like button and subscribe to help us grow this podcast. I'm Odeta Kushi, Deputy Chief Economist at First American, and here with me is Mark Fleming, Chief Economist at First American. And since this episode is publishing on January 1st, Happy New Year, Mark.
Happy New Year, Odeta. 2025 just was an absolute blur and it just flew by. But here we are, new year on the calendar, fresh outlook, and a housing market that, as always, continues along on its own timeline, it would seem.
Exactly. The calendar turning doesn't magically reset the housing market, but the start of a new year is a good time to take stock, reflect, and think about what we think lies ahead. So today, we're going to reframe the conversation around New Year's resolutions, not personal ones, but resolutions for the housing market and the broader macroeconomy in 2026.
You know, that feels appropriate because economists are very good at setting goals, as long as we can add a caveat here, a caveat there, not committing to precise timelines on the one hand, on the other. You get the point.
I do get the point, and I feel like you're specifically targeting me here, but that's okay. We're also equally good at listing all the assumptions required to get to said goals. But okay, before we talk about what we're hoping for in 2026, I think it's worth taking a look back at 2025 because in many ways, the housing market evolved largely in line with what we expected in our 2025 outlook piece. Of course, we didn't catch everything that was going to happen, but I think we did okay.
Yeah, I think we did a pretty darn good job. 2025 wasn't a year of dramatic reversals, but it was a year that confirmed a lot of the dynamics that had already been set in motion in the end of 2024.
That's right. Let's start with mortgage rates because they obviously shape every aspect of housing outcomes. Going into 2025, we expected rates to remain above 6% for most of the year, even as we expected inflation to cool and monetary policy to become somewhat less restrictive.
And that expectation proved right, or maybe we should say, nailed it.
Nailed it.
Nailed it. Rates moved around and ended up the year lower than they started the year. They were closer to 7% at the beginning, but they never broke lower than that 6% threshold.
Rates above 6% contributed to historically constrained affordability, particularly for those first-time homebuyers, and then, of course, reinforced the rate lock-in effect for those existing homeowners.
Which brings us to existing home sales. We expected some improvement relative to 2024, but we were clear that we didn't expect a return to those pre-pandemic norms.
And that's exactly what we saw. As of October, existing home sales were about 2% higher than a year earlier, but still more than 20% below pre-pandemic levels.
Yes, very modest improvement. Inventory improved, affordability stabilized, mortgage applications have picked up compared with a year ago. This is all good news.
It is, but the structural constraint remained. Millions of homeowners are sitting on mortgage rates that are far below current market rates, and that, of course, reduces their incentive to sell.
Those golden handcuffs stayed firmly in place through 2025, and we never expected them to disappear overnight. But the lock-in effect did ease a little bit this year.
It did. We actually just wrote about that recently, and that was, I think, another bright spot in the housing market. But that lock-in effect is why we had made another call, and I think it's one that we got right, which is that the new home market would continue to outperform the existing home market. We have been calling it the housing market's bright spot. While the overall housing market seemed to be in a recession, the new home market seemed relatively resilient.
And of course, relative is key there because new home sales remained above pre-pandemic norms while existing home sales stayed well below.
That's because builders have that flexibility that the resale market simply doesn't have. Rate buydowns, price incentives, and the ability to bring new supply to market mattered a lot in a higher rate environment.
And, you know, we were also right about affordability. We said it would remain constrained, but that it would improve modestly over the course of the year.
Yeah, and affordability didn't suddenly become easy, but slower house price growth, steady income gains, and modestly lower rates helped prevent further deterioration. So progress.
Progress, exactly. And on home prices, we said growth would slow, but remain positive. This was a close call, by the way.
This was a very close call because we are officially below 1% year-over-year growth,
Right.
but not in negative territory. So we can still claim that we were correct. Now, I will say in many markets, growth has been barely positive or even negative, but there were no broad-based national price declines.
Yes, playing the averages is how we did it.
Exactly.
So when you put it all together, the story of 2025 is pretty clear. The housing market made strides forward, offering progress, but is still far from perfection.
Which brings us to 2026 and the macroeconomic backdrop that housing will be operating within. I think one of the biggest differences between the outlook for 26 and the outlook we had heading into 2025 is that the policy environment is on, I will say, somewhat firmer ground.
I agree. In early 2025, uncertainty dominated the economic conversation around fiscal policy, monetary policy, trade policy. It was very uncertain.
That's right. And I think that uncertainty hasn't disappeared, but there's a sense that it has diminished, I think.
That's true. On the fiscal side, we now know what major policy changes are in place following the passage of the One Big Beautiful Bill Act earlier this year. The near term implication is that fiscal policy is more stimulative this year than it was heading into 2025.
And on the monetary side, the outlook still remains data dependent, but the starting point is very different. The federal funds rate will begin 2026 less restrictive than it was at the start of 2025.
And while members of the Federal Open Market Committee may differ on the precise path forward, there is a generally shared view that short term rates are tracking toward a terminal level much closer to neutral than where we've been.
So if we put those together, stimulative fiscal policy and monetary policy that's closer to neutral, and I think the foundation is in solid place for, or is it a place for solid U.S. economic growth in 2026?
That's right. Not overheating, not recessionary, but steady, resilient growth.
And here's where the housing story gets a little nuanced, because a stronger macro backdrop doesn't necessarily mean lower mortgage rates.
Ah, yes. In fact, it often means the opposite. Strong growth, resilient consumers, and fiscal support all tend to put upward pressure on long-term interest rates.
I mean, if the economy doesn't need emergency level stimulus, then mortgage rates don't need to return to emergency era lows.
Very true. So even as monetary policy becomes less restrictive, mortgage rates in 2026 may remain above 6%, not because something is broken, but because the economy is functioning reasonably well.
I think that's an important reframing. Elevated rates in 2026 are not necessarily a sign of stress, but a sign of normalization.
You say elevated rates, meaning rates around 6%? I mean, the long run historical average? Upon what, or maybe when, are you anchoring your elevated relativity here, Odeta?
Yeah, you got me. Actually, I think
Uh-huh.
6% might even be below the
I
long run
think so.
historical
Yeah.
average. So maybe I was anchoring to the low rate environment of the pandemic,
Mhm.
which of course was the anomaly. So let me rephrase. Historically normalized rates in 2026 are not necessarily a sign of stress, which brings us to the first set of housing resolutions for the year ahead, starting with affordability.
Okay, much better. As we have often stated, affordability is really the sum of several moving parts: home prices, mortgage rates, income growth, and expectations of the future. So, which parts are the most resolute, Odetta?
Resolute. Very clever.
I know.
A key resolution for the housing market in 2026 is continued improvement in affordability. And we don't think that that's through some sort of dramatic price correction or collapsing mortgage rates, but rather through slower price appreciation, still positive income growth, and time.
Ah, yes, you remind me of Father Time. He was just here last night. Father Time, then the baby the next day. It's New Year's Day, right? I believe there's a very recent Kendrick Lamar song by this name. A new year and a new more hit me? No? Speaking of Father Time at the new year?
I'm actually sincerely impressed by your Kendrick Lamar reference, but
The
for our
internet, so Dada, the internets.
oh, it's the internet's. Well, let's hope for the sake of our listeners, it's not a new hip mark in 2026. I am actually referring to actual time, an underrated variable in housing. When price growth slows to something closer to income growth, the affordability math slowly gets better, even if mortgage rates stay at or above 6%.
Okay, so the reliable passage of time. There is another resolute part of that affordability story, and really the broader macro story as well, and that's productivity.
Ah, yes, indeed. That's one potential upside to the 2026 outlook: stronger productivity growth, particularly as firms continue to adopt new technologies, including AI. Now, sometimes those productivity gains take some time to play out in the economy, but that's exactly why it's a resolution. I mean, running a marathon has been a resolution for me for a couple of years now, so it takes
And
time.
and this is one that we will probably need to stick with all year to actually see in the data.
Yeah, that's right.
Productivity doesn't always get a lot of attention in everyday economic conversations, but when it moves, it actually matters a lot. Would you care to explain?
Yes. So higher productivity allows the economy to grow without a proportional increase in costs, which supports wage growth without putting the same upward pressure on inflation.
This is like music to the Fed's ears, a best case scenario from a macro perspective.
And from a housing perspective, productivity driven income growth is a sustainable way to improve affordability because it helps households keep up with or outpace home prices and mortgage payments without relying on lower rates or falling prices.
And if productivity gains allow the economy to grow faster without reigniting inflation, that creates space for monetary policy to be less restrictive over time, even if long term rates remain elevated.
That's what we're all hoping for.
A Goldilocks macro environment, shall we say.
Yep, not too hot, not too cold. Steady growth, improving productivity, rising incomes, and inflation that continues to move in the right direction, albeit very slowly.
That's right. That kind of environment makes the rest of the housing resolutions all the more achievable as well.
And that brings us to another resolution, inventory. So, our resolution for inventory is that it will continue to gradually improve.
And that's important because inventory touches everything: prices, affordability, transactional activity.
As you always say, you can't buy for what's not for sale.
Very
And
true.
in 2025, we did see inventory improve, but remain below historical norms in many markets. That helped to take the pressure off prices, but it wasn't enough to fully rebalance the market.
So the goal for 2026 is steady improvement, not a surge, not a flood, but gradual normalization.
And I think some of that inventory comes from builders continuing to deliver new supply. Some of it comes from existing homeowners deciding to list, even if it means giving up that super low pandemic era mortgage rate.
Yes, yes, but wasn't one of our defining features of 2025 the lock in effect?
Yeah, those golden handcuffs have been one of the defining features, but while they're powerful, they're not necessarily permanent. We've actually talked about this quite a bit in past episodes.
Yes, over time, and there is time again, life events outweigh rate lock in. Job changes, family changes, downsizing. These are forces that don't disappear just because rates are staying around 6%.
That's right. So another resolution for 2026 is a slow easing of the lock-in effect driven not by collapsing rates, but by time and life.
And as that happens, more existing homes come to market, which feeds directly into better inventory and more balanced conditions.
And I think ultimately, if we put these pieces together, these resolutions point to healthier sales activity. So the last resolution for 2026, which is really the result of all the other resolutions, is that sales begin to better reflect underlying demand. Certainly not a return to pre-pandemic volumes, which, existing home sales, that was about 5.4 million annualized, but more movement than we've seen in recent years.
And that movement doesn't require perfect conditions, it really only requires stability and confidence.
Right. So when we put all of this together, I think the theme is a trend towards normalization.
Yes, a housing market that functions more normally again, even if it looks different from the last cycle. Thing is, it's actually been a few decades, I think, since we've had normal in the housing market.
Yeah, I mean, between housing booms, housing busts, super low mortgage rates, pandemics, historically fast monetary policy tightening. Yeah, I see your point. Normal has eluded us for some time.
That's right. It's a bit of a walk of life from dire straits back to normal. Get it? Get it?
I don't know why I thought that 2026 would bring fewer 80s references.
Oh, no, no. The new me isn't going to be hip, so I'll stick with what I know. I was thinking actually doing more 80s references this year.
Yeah, of course you were. Well,
Personal resolution here.
a personal
Yes.
resolution. Perfect. Okay. Well, on that note, cheers to 2026. And thank you, as always, for joining us on this episode of the REconomy Podcast. If you have an economics related question you'd like us to feature in the future, you can email us at economics@firstam.com. And as always, if you can't wait for the next episode, you can subscribe to our Econ Center at firstam.com/economics or connect with us on LinkedIn. Until next time.